Okay, cool. We're live. Roberto, Mason, thanks for joining us today. I'll hand it over to you guys to kind of discuss the DAO treasuries and what's wrong with them and how to fix them. Yeah, so I'll hand it over to you guys.
Awesome. Thank you for having us. So briefly, before we get started, I'll give a brief introduction. My name is Roberto. I'm a research analyst at Messari, where I focus mainly on DeFi and macro in general for cryptocurrency markets. Previously, I worked as a quant developer for BlackRock, and then realized that crypto is going to eat the world. So I was like, screw traditional finance, I'm going to go to crypto. And then I just joined Messari.
And then my name is Mason Nystrom. I'm also a research analyst at Messari, where I focus on Web3, NFTs, and a couple other trends. And then prior to joining Messari, I was at Consensus, which is just a blockchain conglomerate. And then before that, I worked at a local cryptocurrency exchange in Hong Kong. Yeah, so today we're just going to talk to you about DAOs. Roberto and I recently did a piece outlining some trends that are happening, some things that we think could be better in terms of these large treasuries and the way they're managed. And before that, I'll just kind of give a brief overview of the DAO ecosystem. So DAO, for anyone who doesn't know, is a decentralized autonomous organization. It's simply a way to combine organizing humans and capital with some software in the back end. And so a lot of DAOs either have smart contracts that allow them to automate certain functions or allow for coordinated voting, similar to how you would see in like a traditional shareholder meeting. And so the DAO landscape is pretty new, very nascent. It is kind of composed of a few different frameworks, if you will. So ways to set up DAOs. Some of the most popular include Aragon, DAO Stack. You have Colony, Moloch, which is another framework implemented by Consensus and DAOhaus. And then you also have just some other kind of one-off independent frameworks that are spun up by the likes of a few different tools like Gnosis Safe, Snapshot, and stuff like that. And so kind of the big takeaway here is that as a lot of these crypto protocols grow, they issue all their tokens at once, reserve a certain portion for their reserves, their treasuries, or their communities that they want to figure out how to deal with later. It's a little different than, say, a traditional startup where you would issue all your equity over time. In a tokenized world, you kind of issue it all up front. And so you have to manage how you want to do that over time in terms of, do you want to continue to issue it for marketing expenses or other incentives? How are you going to pay people? And there's not really a lot of structure really or development along how most of these DAOs are going to do that. And so they're currently sitting on, as you can see, like tens, if not hundreds of millions of dollars in capital. At the top, it kind of shows the total AUM. And I think it's, around like almost $1 billion, like 750 million right now. And so as we get into like our piece, you'll see, and Roberto, can you go to the piece? You can see how massive some of these larger protocols are. So if you look at Uniswap, Compound, Aave, these have treasuries worth billions of dollars. And that's pretty significant when you're talking about companies that are maybe 3-4 years old, and they don't really have a lot of, operational costs because it's just a smart contract that's securing a lot of their functionality. And so a lot of these protocols have also spun up DAOs to help decide how to allocate this capital in a decentralized way. And that becomes even more contentious when you're talking about billions of dollars, because now suddenly, if you work for this DAO, you can earn a significant portion in tokens that can be meaningful over time. And so as you can see, these DAOs kind of through inaction are just sitting on hundreds of millions of dollars, being indecisive in terms of how they spend it. And go for it.
Yeah, at the moment, the way these DAOs, there's still not like a standard way for these DAOs to like raise their treasury. Like a lot of them, for example, in the case of like Comp, they take like a little bit of each one of the interest that they charge in loans. in Sushi's case, 10% of the emissions go directly to the treasury. So like the way these treasuries are being accumulated differs from protocol to protocol. But the growing trend is like they just have so much money. And like the reality is that when you speak with them, they're developers. And they have no clue about how to manage treasury, how to manage portfolio. So all of this crisis kind of from that kind of problem where like they're like fantastic people are growing protocols, not great money managers.
Yeah, and part of it is just we're in a new era where you don't really know how this capital should be spent. It's not a traditional startup. Like, what is the best ROI? Should you be putting money into your protocol, other protocols? Should you be earning like a long-term interest? All these questions that don't really have answers. And so it's not just these top 10, it's like dozens of protocols that have hundreds of millions of dollars lined up that they don't really know how to allocate. And when you start to look into what is this money actually comprised of? Like, is it in US dollar? Is it in some other stable coin? Is it in a native asset? You find that almost the entirety of these DAO treasuries are in their native assets, their native tokens. And that becomes like pretty staggering when you compare it to a lot of the other top DAOs, because here you see that only two really have significant allocations to something other than their non-native asset. And that gets really dangerous, as kind of Roberto will dive into in a bit. And so the kind of last portion, the last graphic that I want to touch on below just shows these are the smaller DAOs. So even in like, it's not just like large DAOs, it's like pretty much all DAOs don't allocate their treasury well. And if you think about it from a contextual standpoint, it's probably more important for a smaller DAO, a smaller organization, to allocate their treasury to some other type of like stable coin in order to secure short-term expenses. But that's still not really what they're doing. And so that's pretty shocking when you look at it from just an operational perspective. And so like the final graph below shows how many DAOs actually have protocols, or how many DAOs actually have assets not in their native token. And it's a pretty small amount. This includes, I think, like almost 40 DAOs that we took a look at. And a lot of the DAOs that you see right here that do actually have some sort of stablecoin allocation are investment DAOs, which makes sense because that's how they raise their capital. And so when you factor those out, it's probably like maybe 8 or 9 DAOs that have an allocation in their treasury to something other than their native asset. And Roberto can talk more about how that's not the optimal strategy for an organization, whether in traditional world or crypto, to do.
Any questions? We just dumped a bunch of information before we move on to the next section.
Yeah, if you guys have questions, feel free to raise your hand or just type in the chat to you guys.
No questions. Okay, cool. So the idea behind this piece was really to show the fragility that a lot of these DAOs, the treasury of these DAOs currently has. And as mentioned, as Mason was mentioning earlier, the composition of this DAO is like entirely, like most of them is entirely into their native token. So what I mean by that is that Uniswap's treasury is like entirely Uni. Com's treasury is entirely Com. So when you look at the characteristics of these assets relative to Bitcoin, relative to Ethereum, you tend to see that the native tokens are a lot more risky than Bitcoin. And why is that a problem? Well, like if Bitcoin sneezes, then their native token or the treasury is going to naturally tend to lose a lot more value relative to the broader market. So the idea behind the piece was look, your treasury is 95% your native token. Your native token is 10%, 50% more volatile than Bitcoin. If Bitcoin drops 10%, you're probably going to lose like 50%, 60% of the value in your treasury. Why is that a problem? Well, for these DAOs, this treasury is essentially their funding mechanism, right? Like they have to fund marketing, they have to fund liquidity incentives, they have to fund any kind of incentives programs, they have to fund development. So whenever you get in a situation where your treasury loses 60, 70% of its value, then all your funding basically evaporates. And later on, this is essentially what we saw in the March, in the May drawdown, mid-May drawdown, where like we saw this treasury is like shrinking 60%, just because they were just not allocated to anything else that was less risky than the native token. So the idea here, we took PiDAO as an example because they had a decent mix of like native tokens, stable coins, Ether, Bitcoin. And we highlighted, look, the treasury is 86% allocated to DAO, which is their native token. But really the risk contribution and the risk that is associated with that position is like more than 90%. What that means is that the volatility in your portfolio, in your treasury, is entirely coming from your native asset. The second chart here is really to showcase that the volatility of DAO, almost like double the volatility of Bitcoin. Again, to reiterate that if Bitcoin sneezes and like if Bitcoin drops 5%, 10%, you're probably going to lose a lot of the money in your treasury. So what we ended up doing is like we kind of stress tested the portfolio, and by that I mean we wanted to get. Was that a question? No, okay. So what I was saying is that we wanted to quantify the impact of a Bitcoin drawdown on these treasuries. So what we did is that we looked at Bitcoin historical drawdowns, and we created a few scenarios. And we said, okay, what would happen to PiDAO's treasury if Bitcoin were to drop 10%, 20%, 50%, 80%? We wanted to base these scenarios according to like some historical data. So what we looked at is like Bitcoin's average drawdown since 2016 has been 10%. The worst one has been 84%, which happened in 2017. So we constructed those two scenarios based on that, and we evaluated the value of the treasury based on those values. So we scroll down here. What we wanted to show to PiDAO people was that as the shock of Bitcoin increased, you are losing so much money relative to like your starting point. So like when we did this, PiDAO's treasury was roughly like $114 million. If like the Bitcoin worst case scenario of like an 84% were to realize, they would like their portfolio would shrink by like 100 million, leaving them with like 14 million dollars in the treasury, which is really not enough for like anything related to like their day-to-day operations. So what we ultimately also showed was that there's other ways to diversify your portfolio, right? Like you can have some allocation to Ethereum, some allocation to Bitcoin that would kind of align the or like distribute better risk and like reduce the actual volatility of your portfolio. So as an example, because we didn't have all the details of the treasury of PiDAO, we just created two hypothetical scenarios. One where we allocated 50%, like 50% of the portfolio to ETH and Bitcoin, and then one where we like say, 30% is gonna be in DAI to like make sure that there's enough money to like continue operations for the portfolio. So this slide right here is really like to show the comparisons in terms of risk and risk contribution one, and then total risk of the portfolio, and another one of the two portfolios. Which ultimately, when we wrote this was like 2 weeks before the May drawdown. So Mason and I, we joke around all the time that we say like, it'd be awesome if we had implemented something like this, because when Bitcoin dropped 50, 60%, not 50%, but like, it was like more like 30%, Ethereum dropped like 50%. In like a matter of days, like those PiDAO treasury just like shrunk completely. So it would have been a good case study. Anyway, so that was kind of the analysis that we carried out for this specific treasury. Mason, I don't know if you want to touch on the long-term balance sheet management here.
Yeah, I mean, it's just kind of a short point. Like obviously in a bull market, it's different the type of market you're in. So if you're in a bull market or bear market, like you have different requirements for your team's funding, how you want to spend your incentives. stuff like that. And so it's important to, we're like, part of this is not advocating that these organizations move 50% of their native assets into stable coins, because that's not really a realistic thing. Like, they want upside to their token. But even allocating like 10% so that you can secure a couple $1 million for the next 3 years, if you do have a bear market that lasts a similar time or longer, like, you have to be able to kind of plan for those unforeseen events. And so that's kind of just the idea of short-term management. This picture is more so to highlight how different treasury management is going to be in the future, because you have a lot of different organizations that balance sheets look wildly different. And so, like, you have Yearn, which is actively borrowing debt in DAI and USDP. They have other types of assets like indices, and obviously their own native token. And then you also have newer type organizations like NFTX, which is a indice protocol for NFTs, which actually owns a lot of its NFTs on its balance sheet, which is pretty unique. And then you have Decentral Games, which also is a casino built in Decentraland. And so they have a portion of their balance sheet that is Decentraland land. And how you examine the risk for each of these different portfolios is incredibly different. And it's going to get even more complex and interesting over time. And so, like, this is a very like 101 level of what risk management looks like in a DAO. And there's going to be new frameworks that need to be created as these balance sheets get more complex.
Mm-hmm. One common criticism that we often get when we speak to teams about diversifying their treasury is that the community is going to hate it, because how am I going to hold a native token for a given project if the project itself is dumping its native token? So we had a conversation with a fund the other day that was interested in like kind of figuring out a way to, you know, inject some risk management into the treasuries of their company portfolio, the portfolio companies. And what they were saying is that at this moment, we have to go through a learning process with these treasuries and with these protocols, because they don't have a lot of formal training in risk management. They don't have a lot of formal training in a financial background or like in portfolio management. So at first glance, when you say, hey, like, I need to, you know, diversify a little bit, and that's going to mean like out of my 95% allocation to my native token, like I need to sell 30%. It's not bad. I'm not bearish on my token. It's just that I want to protect and I want to be able to like have enough funding and runway for the project to continue in the case of any like market drawdown. So yeah, I think,
and just touching on that, not every aspect of finance has to be reinvented. Like, you're able to, you know, sell your shares when they're at a market, you know, like local high, and buy more back at a later point in time with excess capital. Like, that's a totally fair strategy to take, but one that is less, it's sometimes stigmatized in crypto for some reason.
Mm-hmm. Yeah. And the last thing I want to point to is that now that these protocols are becoming like a corporation, like a startup, a lot of different skill sets are going to be very valuable in the next 2-3 years. Not only back in 2019, 2020, maybe like 2017, the biggest skill set that you could have in the crypto industry was to learn Solidity and like how to like code smart contracts. Now that crypto encompasses more than just programming, it's like economics, it's finance, it's now portfolio management. A lot of the skills that business majors and like we non-technical people have are going to be extremely useful to like push crypto to the next leg up. So I imagine an influx of talent is going to come in to meet the demand for this kind of skills, which is really exciting, because I don't know how to code in Solidity, but like some of my risk management skills can be used for this DAOs. Anyway, any questions? Anything that is not clear?
Question on my end. Go ahead.
Yeah, so like what startups or what like tools are out there that are trying to solve some of the operational issues relating to treasury management?
So at the moment, there is a YAM. There's a product by YAM. I don't know if you have more color on that, Mason. I've just seen it, but I haven't like delved much into it.
Yeah, I would say no one's figured it out yet. Some DAOs have attempted to formalize kind of their own frameworks for treasury management. Some of the bigger DAO frameworks that I discussed earlier, like Aragon, like Moloch, they don't necessarily have parameters where you can say, oh, I want my treasury to naturally adjust every quarter or rebalance every quarter. None of that exists yet. I would say most of the tooling for DAOs has been on the governance side. Like how do we make it more efficient for people to vote, to discuss proposals, rather than optimize our balance sheet? But that's very important.
Mm-hmm.
Got it.
I think that, yeah, go ahead. Go ahead, Brian.
Oh no, that was it. I said got it. Thank you.
Yeah. Just to piggyback off of that, the tooling in DAOs, like Mason said, is like it's like there's no tooling for treasury management, or at least it's very primitive. And again, it is mostly the things that are out there are mostly created by developers. So someone with a portfolio management background or a balance sheet background would be extremely useful to create this kind of tooling for DAOs as the whole sector grows over time.
A question on my end, Mason, you brought up the point earlier about the stigma in crypto from selling tokens and diversifying your balance sheets. Do you think there will be a similar or maybe greater or less backlash against diversifying by, I don't know, allocating the balance sheet to, say, a hedge fund or a private equity firm, or by buying traditional equities, bonds, real estate, that sort of thing?
I wish there wouldn't be, but there probably is going to be some sort of stigma. I think it seems to me that most DAOs, because they're so digitally native, want to operate in a digitally native way. And so they might look to purchase similar diversified products, but from crypto protocols. So like they'd be totally fine probably buying bonds, but they want to do it in a way that is maybe more crypto native than having to go deal with another legal entity, because not all DAOs actually have legal entities. In fact, very few. You have to use like a allow framework in order to have like a legal entity with your DAO, and that can get really troublesome for some of these protocols that are operating money markets that are trying to avoid, I would say, like scrutiny from securities regulation.
Got it. Thank you.
And I think to add to that, Daniel, the stigma is really not where you allocate your native token in. It's more getting rid of your native token altogether, because the community sees that as bearish on your end, right? Like if I am the protocol and if I'm Compound and I'm like dumping all my comp in the open market, then as a comp holder, I'm gonna be like, well, like protocol doesn't even believe in its own token, so like why should I hold it? So the stigma really comes from that, not from where other asset I could have it in order to diversify my portfolio.
Is it just
and again, go for it.
Maybe you can tackle both of these at once. As a follow-up question, is it possible to hold on to the token, not dump it, but have some financial product that gives you exposure to other asset classes or other crypto tokens?
Yeah, so here, this just kind of leads into what I was going to say. You haven't even seen a lot of DAOs take on debt, which would be like a very normal traditional thing to do. And part of that is just because operationally, it's not very easy. Someone has to manage. You have to either coordinate the key management to purchase the debt, agree on how much you want to take. But so you could, if your protocol native asset is, say, a collateral allowed in Maker or Cream or one of these other different lending protocols, you could put that up as collateral and take some debt out and then just pay whatever the interest rate is. So that is one option, but hasn't been as utilized yet.
Mm-hmm. And I think this just highlights that there are really not a lot of tools to get that kind of exposure that you're talking about, Daniel. The only one that comes to mind is UMA is a synthetic protocol that's been around for a while, and they released something called a range token. Which, I mean, I haven't really delved too much into it, but the idea is that you're going to have some sort of like collateral debt. I'm sorry, convertible debt, in the sense that you pony up your native tokens and use that as collateral for a specific bond. You can do whatever you want with that borrowed money. But if you don't repay it, obviously you have to pay some of those tokens. And in that way, you can get some financing without actually selling your native tokens.
That all makes sense. Thank you.
I see a couple of questions in the chat. Kind of good follow-ups to this. So the first question from Andrew says, do traditional modern portfolio theory / risk parity strategies apply here? Somehow it feels like the market is so systemically correlated that it's not clear that TradFi concepts translate.
Dan, that's been the bane of my existence, Andrew. Like, I have tried risk parity in this thing. I've tried mean variance optimization in this thing, and it doesn't work. Like you said, like you nailed it. It's because all correlations are like literally one. So I mean, not one, but like very close to one. I think the portfolio framework that I've been most successful at implementing is risk parity, just purely because, and this is risk parity without leverage. So just like, equalizing the risk contributions of the assets that I'm holding. That's been the most successful in the sense of distributing risk and, like diversifying a little bit of the portfolio. Because like any other kind of portfolio optimization framework, like mean variance, it's just gonna like end up in a horrible situation.
Yeah, another question here from Andy says, why can't they switch to stablecoin backing?
Is that in reference to like obtaining debt and collateral, or?
I think that one was from before. Maybe Andy, if you want to clarify, but it sounds like he's asking like instead of getting funding from a native token, getting funding from a stablecoin.
Yeah. Basically that. I thought you mentioned earlier that like Bitcoin's price fluctuates quite a bit, and that causes their treasury value to also fluctuate. So I was just wondering why they can't just operate using stablecoins.
So they need to have, that's absolutely what we're trying to preach, Andy. Like, yes, you should have more stable coins because you need to pay expenses. You need to pay short-term expenses for your developers, for your marketing, and for like everything else. Now, the main criticism that we've gotten back to is like the allocation to a native token is on purpose, just because it's the main mechanism that these treasuries use as incentives. So like if you are providing liquidity in a Uniswap pool, like they have to pay you in their native token. So every time that we talk about with them, they're like, yeah, this is on purpose, and we use it for like our incentive programs in general. And now, go ahead, Mason.
I was just saying, and to be clear, like that's a terrible strategy. Like all these protocols are just paying their employees in their native token, which is bad from like a tax perspective for your employee, but also bad because as the speculative value of your token, goes up or down, you're paying your employee either a lot more. Like one of Uniswap's grants committee members was making like $100,000 a month because the token was at a fixed price per month payment, but it just appreciated so much. And like you're effectively like over allocating to like that individual in the short term.
Any more questions from the chat, Roberto?
I don't see anything else. If you guys have anything else, please feel free to add to the chat.
What do you guys? Hi, I'm Alan here. What do you guys think about buying put options on your own token, like short-term put options, and just keep rolling them forward as a hedge?
Perfectly fine strategy. Again, I think this goes back to like the fact that the people that are managing the protocol probably have no idea how to like implement put options in the treasury. So it's partly that, partly I don't think there is the infrastructure, the products to actually carry out something like that on chain. But I imagine like this is going to change in the next 3 to 6 months.
Yeah, right now there's really only robust options market for Bitcoin, ETH, and maybe like a handful of tokens.
Mm-hmm. I got another question, maybe.
Got one in the chat here from Jeremiah. He says, how do you see the difference between on-chain treasuries of native blockchains such as Polkadot or Kusama and the DAO treasuries you've discussed?
I mean, from a risk management perspective, I don't think it's any different. Like these foundations should also manage some of their capital well. The Ethereum Foundation is a classic example of this. They had a significant portion of Ether, and then once the bear market came, I think it ended up being worth like $10 million, and they were significantly underfunded for everything that they wanted to do. And had they at least sold like a percentage of the tokens, like anywhere near like 50% of the top, they would not have been in that position. So I don't think it changes, and it's in fact maybe even more important for these like native ecosystems, because you want to be able to ensure that incentives can remain.
Any more questions from anyone? Okay, well, thank you so much for tuning in, guys.
Hey guys, I have one more question. Sorry.
Sure.
Just from like thinking about it from the investment like side, are there any like of the investors or VCs who are actually thinking about this for their portfolio companies, or like developing tools inside in the house?
I'd say yeah. Like we had a conversation with CoinFund last Friday, and he like I remember your name, Mason. I can't remember his name.
Jake.
Jake was just very like, he reached out to us just asking like, hey, like, is there any service that you guys can provide in order to like kind of help out some of my companies in terms of risk management and portfolio management of the treasury. So I think there's definitely like this awareness. The mid-May drawdown that we experienced also kind of shed light on this issue. That we like really need to like manage our treasuries in a better way in order to like fund the future development of the protocol. So I think, like I mentioned earlier, like over the next 3, 6, 1 year time frame, we're going to see a lot more just push on this area.
Thanks.
I had a quick question as well. Oh, go ahead.
Go for it.
Yeah, is Messari, and apologies if you guys answered this in the first kind of half, I missed it. Is Messari trying to develop a solution to any of these problems?
So at the moment,
so we are.
Go
for it.
No, you go.
I was just saying we are looking at it from the risk analysis side rather than like the operation side. So we're not actually going to like help these protocols execute these strategies, just because that's requires a lot of multi-sig coordination, and it's just not something that we want to focus on. But as far as the analysis, recommendation of portfolio allocation, that is something that we are focusing on, as well as from the governance perspective of how are we tracking all these proposals, how are we monitoring how these networks are voting, how are we monitoring kind of the major stakeholders in the network. And so all the things that kind of tie into that governance aspect of a lot of these top protocols, we're actively looking at that side of things.
Mm-hmm. And just to be clear, the like any allocation changes to a treasury probably always go through some sort of like community proposal. So we're tackling this from the point of, we can do the analysis, we can provide you some recommendations based on whatever financial goals you have. And then we will open up and post our research and in our site as a way to like spread it out to your community. And ultimately, like ideally, have a way for you to like actually vote and just participate on these proposals on the site. Like Mason said, like the operational aspect of things, actual trading and actual allocation, that will leave that to like someone else to handle.
All right, yeah,
Hey guys.
thanks.
Sorry, yeah, it's Richard here. Yeah, I just want to say thanks for the presentation and the work that you've done. I think this is a very hot topic in the industry. I think the main problem at the moment now is how do you raise without dumping your tokens? Like, so those tools to kind of diversify, you know, as I guess is a couple of options is like, you know, OTC or go to another VC and raise another round and sell some tokens and have it vest for a year so you don't get, you know, so there's not too much emissions. And then you mentioned the UMA option. Will you kind of perhaps do a follow-up to this article to explore those options a bit more and just sort of provide a bit more provision around, you know, what to do next?
Absolutely. I think that's something that
Yeah.
we should absolutely do, Mason. Okay.
And just quickly, Roberto, if you scroll down in the piece, there's like kind of 4 different ways that, or maybe it's up, where I talked about like how you'd actually do this right there. Yeah, so like there's a couple different scenarios by which you do this. Like you said, the one is you just sell the tokens on the market and dump, which is not a good strategy. And kind of the ultimate scenario ends up being either doing some sort of OTC sale or going to an investor raising a round. But notably, that's actually not always desired by the community. And so, for example, like Pool Together just raised a round as an OTC sale to a couple different venture investors. And then once that was proposed in the community didn't like it because the investors were getting, I think, like a 20 or 30% discount based on like the 30-day, you know, moving value. And that is pretty contentious if you're saying, hey, we're going to give these investors, you know, a discount for value they're going to provide when you're a community member and you're thinking, hey, don't I provide value as well? And so it's definitely a operational point that has to evolve, and the optimal strategy I don't think has been seen. And other people are trying out different models, like Index Cooperative announced like that they were going to do a reserve round for their community members who had contributed to a certain level in the protocol. So lots of interesting ways to game getting investment through the Treasury, but from active and valued participants.
What was the last example?
Index Cooperative.
Okay, got it.
Any more questions before we wrap up?
I have a question, maybe kind of going back to one of the previous questions that was asked, like in these examples, maybe none of these 4 scenarios kind of puts forth the idea that potentially one of these DAOs could just raise capital via stablecoin, right? So like couldn't one of these DAOs just raise capital via USDC or via you know, I don't know, DAI or something like that?
I mean, you could by putting it up for collateral, or you could just raise. I mean, like you're talking about like a traditional fundraising round. The point is like a lot of these protocols don't have equity, so like
Right.
what is the investor getting? Debt is definitely one way you could do a financing round, though.
Something totally unexplored in this thing. So we need protocol politicians out there to like figure this out for people. And like I said, like I think like a lot of skill sets that you know, we have are going to be more useful in this space as it matures.
Totally. Okay, great. Well, yeah, I mean, if we don't have any more questions, we can wrap it up here. Super appreciate you guys taking the time to go through this. I think somebody else said it too, but super hot topic, and definitely has to be figured out, right? I think if the DAOs are going to be competitive with, you know, traditional finance and everything else, they have to have the tools to, you know, fight the good fight, and this is a big part of that, right? So
Definitely.
hopefully that becomes a thing.
Sure.
Absolutely. Thanks
Yeah,
for.
and I guess the
Mhm.
last kind of plug is Messari is actively hiring. We're doubling our team on everything from business development to engineering to our research team. So if you think it'd be some place you'd be interested in, feel free to reach out to Roberto or myself, or check out our jobs online and apply.
Cool. That sounds great. That's it sounds like a good way
Shameless
to
plug.
help. Yeah, to help fight the good fight. I like it. All right. Thank you guys for joining us. Yeah, we'll post the recording on our YouTube channel as soon as I get it up. And thanks again, guys. Appreciate you guys making
My
the time.
pleasure. No problem.
Thanks, everyone.
Thank you, guys.
Thank you. Goodbye.